Hello, and thank you for joining us today. Very excited to have Kyle Sood, who's a mortgage specialist at BMO, and we're going to talk about mortgage options at renewal. I have a lot of clients asking me what they can look to do come their mortgage renewal, as some have come off a 5-year fixed and now they're looking to their options, and it's a different interest rate environment, as we know, as it was a few years ago. So very excited to have Kyle in today. Share his thoughts on what the options are, what to look for, when you should start engaging in the process, and just some tips and tricks with regards to your mortgage renewal. So without further ado, we're going to get started very soon. And I'm Eric Watchman, part of the WWH Financial Group team. I'm very excited to have Kyle Sood from the BMO Mortgage Specialist team here with us today. This is our team. If you're not familiar with us, it's 3 advisors. We have 2 associates, and we deal with 350 client families that we manage the financial assets and investments for. And we build plans for the future, retirement, savings, and all under one roof. So that's our team. And then our guest today is Kyle Sood. So very excited to have Kyle, who's been with BMO for a significant number of years, and 15 years in the industry. So very knowledgeable resource that we've worked with on a few occasions in terms of getting clients into new mortgages, into renewing mortgages. So very excited to have Kyle today. So Kyle, I wanted to introduce you.
Thanks. Thank you, Eric. Thanks for having me. It's a pleasure being here today. Always a pleasure, chatting with you and Asante in general. And so without further ado, I'm just gonna get into it.
Yeah, let's do it. So first thing, as we jump in with Kyle, first thing that we wanted to look at, Kyle, is what happens at a mortgage renewal. So say a client has been in a 4-year fix, a 5-year fix. What happens when it comes time to renew? Can you take us through that process and share what that looks like for clients that are in that scenario?
Yeah, definitely. So typically what starts happening is it's bank to bank, but mostly banks start contacting their clients between 6 months to a 3-month window right before the mortgage is coming up for maturity. So some banks start getting in touch with you 6 months before you hit your maturity date, and some banks start getting in touch with you 3 months before you hit your maturity date, because they want to keep your mortgage on the books. They want to lock you in for another term, whether that will be 2, 3, 4, or 5-year term, whether fixed or variable. So every bank is proactive, and they want to keep you on the books. So typically, they'll send you a notification in a mail saying, hey, your mortgage is coming up for renewal, let's say on 1st of April or 1st of May. These are your options, and they'll send you all your renewal options and the rates in that letter itself. Now, you can either just be someone who's not very proactive and just go with what they offer you, or, as I say, you want to be that proactive customer, especially in this rate environment, and you want to look around at what's available. Typically, the bank who you are banking with or who have that mortgage with already, they're not going to give you a stellar rate, because banks' focus is more on new acquisitions, on bringing new mortgage balances to their books. So they'll give better offers, better options for new clients versus existing. However, having said that, like I said, it all depends what kind of client you are. If you are a proactive client, you can go to your bank and say, I'm not happy with these rates that you're offering me. I want something better. Again, now, depending from client to client and your existing relationship with your bank, how many other products you have, what kind of investments you have, what kind of balances, bank accounts, lending products like lines of credit cards, and other borrowing options that you might have. So depending on your share of wallet, that bank might go back to their manager or manager above and say, listen, we have this client with all these different products and this relationship with us, and we want to kind of keep that and honor that. So we want to give him more discount on the rates we initially offered him or her. So they might come back and say, okay, we can do a little bit better. They might shave off like 0.10 or 0.20 off the original rate they might have offered you. it's up to you if you like those rates. And if you still don't like them, then you want to shop around. Now, what happens is when you start shopping around, you will probably get better options than what your bank is offering you. For example, I'll tell you what's happening right now is right now, BMO, we have a special offer going on that if you were to switch your mortgage from another financial institution or refinance your mortgage from another institution, you can earn a cash back up to $4,200, depending on the size of the mortgage, plus we'll give you a pretty aggressive interest rate as well. So right now, I am already working on 2 mortgages that just came to me just as an inquiry since last week and this week that, hey, my bank is offering me this upon maturity. What can you do? And the moment they heard the cash back, they liked it. Again, our cashback is tiered. So like I said originally, it's dependent on the size of the mortgage. So between 100,000 to 500,000, we're giving like a $1,200 cashback. If it's a mortgage between 500 to 750, I believe we're giving 2,200. If it's between 750 to $1 million, we're giving 3,200. And if it's $1 million and over, we're giving 4,200 cashback. Doesn't matter if it's a rental property, primary residence. That's an incentive we have right now for bringing your mortgage over to BMO. And additionally, we'll also try to beat the rates that your bank is giving. Typically, it's easier because, like I said, the banks are not very aggressive when it comes to giving or offering interest rates on renewals to the existing clients.
Right.
So it's, I believe, at least in the current scenario, where the rates are already so high, you want to try and save every or make every penny, every dollar you can by being proactive. So that's what's happening currently in the renewal space. And with that, I mean, I can kind of transition to another of your questions, which would be a nice segue. Is the typical question I get is, what should I do with my interest rate? Should I go fixed or variable?
Yes.
Now, just to give some background of where the rates are for some of the people or customers who are not familiar of what the current rate environment looks like. Prime rate, which is Bank of Canada's rate, is currently sitting at 6.7% with that 0.25% increase we had on January 25th.
Just adding as of February 8th for those that are listening, in case that changes, and it's out there. So
yeah,
proceed.
And so yeah, as of today, February 8th, the prime is sitting at 6.7%, and we're offering prime minus 0.3, prime minus 0.4 on that. So you're looking at about 6.3, 6.4% as a variable rate option right now. And then also, as far as the fixed rate goes, we're sitting at about between, I would say it's hovering between 5.1 to 5.4, depending on what kind of term you go for. So whether it's a 2-year, 3-year, 4-year, so the range is sitting between 5.1 to 5.4% from 2-year to a 5-year term. So just to give you some kind of a range, again, it will all depend which term you end up going with, and the final rate would depend on that term.
Yes.
So that's what the rates are. And when the client's asking what term, because as of today, February 8th, we're in a very tricky space because all the mortgages maturing now, clients have been used to such low rates in the past, and now when these mortgages are maturing, all of a sudden they're going from a 2%, 2.5%, 3% to 5.5 on fixed, and between 6.3, 6.4 on a variable, which also will make their payments jump because the bank will have to adjust your payment now based on the new rate. And in some cases, there is 30-40% increase to your payment, because obviously the bank would want to keep you within your remaining amortization. And for that to happen, the bank has to adjust your payment to the new rates.
Right.
So what I am typically telling clients is I would go in for a 2-year fixed right now, where I don't want to commit to a very long term, like 3, 4, or 5-year term. because I feel pretty comfortable and confident that the rates will be much lower in a 2-year space. So I don't want to get my clients to lock them in for a 3-year, 4-year, or 5-year, because I feel pretty confident that within 2 years, the rates should be on a low trajectory. Right. So I don't want them to commit to a long term. And also for variable, some clients feel very comfortable with variable. So same is going to happen for variable as well, that I feel within 2 years, prime will be much lower where it's sitting now. So yes, like clients can go in for a 5-year variable now, but they'll start off with something higher, like we're talking 6.3, 6.4. And we still don't know if the rate's going to go higher anymore, because the Feds in the US just met this week, and they announced that like they're probably not going to slow down on the rate still, because inflation is still hovering at 6.3, 6.2%. I know in Canada, our aim, the government's aim is to bring it to 2%. Right. And we're still miles off that, as we are hovering at 6.2, 6.3% right now. So we did see a smaller increment in January to prime, which was a quarter. So that was the first time that the increment had dropped, because in the past, every time we increased prime over the past year, it was always a 50 basis points jump, versus the most recent one last month was only a quarter point. So I have a feeling that we will still have some interest rate hikes, but they will be smaller. So they might continue being in that quarter percentile space. So the impact is not that big as we've been feeling with half a point, half a point, half a point each time previously. But I also feel the same time that we are kind of getting to that end of rate hike. So there might be a couple more quarter percent hikes. And I think that might be it for now, for the time being, unless we don't see any drop in inflation numbers. But I mean, we're already seeing some big drops in the inflation space. So fingers crossed that those inflation numbers come down soon, and the impact of these rate hikes is felt sooner than later, because the sooner we can bring that inflation number down, the sooner we can stop these rate hikes.
Yeah, that's a great point. I think your insight on having the 2-year fixed and having that assess rather than locking into a 5 years is a really good point, and definitely worth considering for clients that are in that space. I wanted to, and you mentioned the increase. I mean, a 30 to 40% increase in mortgage payments year over year, that could be significant for clients. When you talk about variable mortgages and a term that's used, a trigger rate, can you just share what that means, what clients can see, and when that would apply, and just some thoughts on what that transition looks like for clients that might be at that trigger point?
Definitely. So trigger rate is only applicable to variable rate mortgages, because when you take a variable rate mortgage, let's say you took out a variable rate mortgage 2 years ago, when prime was sitting at 2.5 and bank was giving you prime -1 and your rate was 1.5%. So when your mortgage was originally set out at 1.5% variable rate over a 30-year amortization, it was set out at an assumption that 1.5 will be the interest rate over 30 years. That's why your current payment, whatever that was at the time, at 1.5% interest over 30 years was what it was, because it was based on an interest rate of 1.5%. Now, because there was a variable rate, that meant that the rate could go up or down during that 5-year term that you kind of took in that variable rate space at the time, because our 5-year our variable rate is a 5-year term only. So that meant that if the rate went up during these 5 years, then if prime went up, your rate also went up. If prime rate went down, your rate also went down. Unfortunately, in the last couple of years, we've only seen prime go up. Now, what is the impact of that? So if you started off at 1.5% 2 years ago, and prime since has jumped 4.5%. So 1.5 plus 4.5 is 6%. So the mortgage now, which originally started off at 1.5%, is currently sitting at 6%. So what that means is that you've probably hit your trigger rate. A trigger rate is the rate at which your mortgage payments do not cover your principal anymore. And your mortgage starts going into a negative amortization as a result of all these rate hikes. So what's been happening for the past year, since we've seen these rate hikes since March 2nd of 2022, every time there is a rate hike, the bank will send you a letter in the mail, just kind of informing you that your rate's going up, and what you should do proactively is maybe consider increasing your mortgage payment now, or start putting lump sum payment options on payments on the mortgage to kind of start contributing more towards your principal. You don't have to do any of this, but the bank is proactively telling you over and over with each hike that you should start doing this as a best practice, because the moment you hit your trigger rate, your payments will stop covering the principal. And if you don't make any changes now, the repercussions are going to be that when this mortgage matures towards the back end of the term, you will be hit with a pretty dramatic increase to your mortgage payments, because
that 5-year term,
yeah,
right? 5 years.
yes,
Okay. Yes.
That your payment will be hit with a dramatic increase towards the back end at the end of that 5-year term, because you failed to either increase your payment during these 5 years, or you also didn't make any additional lump sum payments to your mortgage. Because with both options, you would have contributed more towards the payment, and also you would have paid some portion of your principal, which would have kind of kept you in check. But because you didn't exercise any of these options, your payment could actually double than what you were paying in some instances, depending on how much higher prime went during this 5 years. We already know that already it's gone up 4.5%. So someone who started off with a 1.5% interest rate on a variable 2 years ago or 1 year ago, their interest has gone up 3 times. Like 1.5 times 3 is 4.5. So the current interest rate is sitting 6%. So technically, the mortgage interest rate increased 3 times, and it's sitting at 6% now. So, which means that you are really, really behind on your principal. So I've had a lot of clients who have been proactively increasing payments, putting lump sum payments. I personally like the lump sum payment option, because every time you put a lump sum payment, everything you put on the lump sum goes directly on the principal. So but at the same time, some people don't have that much savings sitting with them. So they prefer paying something gradually, which would be, in which case the better option would be for them to increase their monthly or bi-weekly payment, even if it's increasing it by $200 bi-weekly, $300, $400, but at least do something so that upon maturity, you are not hit with a massive increase to your monthly or bi-weekly mortgage payment, because as I was saying, in some cases, it could even double depending how high these rates go over this 5-year term that the clients have, if they don't take any or exercise any of these options.
Mm-hmm. No, that's great. And 2 things I want to zoom in on. So you discussed making a lump sum that can go directly towards the principal. Can you just quickly share making a lump sum versus, say, making accelerated biweekly payments, what the difference would be on the mortgage side? Is there a difference for clients? And are there any limits in terms of the lump sum that can be made in general terms?
Yeah. So accelerated biweekly, so you are paying, so normally when you make even a regular biweekly payment, you end up paying 2 extra payments in a year, because biweekly payment frequency has 26 payments in a year, versus if you were to make semi-monthly, which is 2 payments a month on the 1st and 15th, that is 24 payments a year. So bi-weekly itself gives you 2 extra payments in a year, which means you're paying off your mortgage a little bit faster compared to a monthly payment or a semi-monthly. But if you do accelerated bi-weekly, that is actually paying off a little bit even more, because in accelerated bi-weekly, the payments that you make, depending on the size of the mortgage, there is an additional $40-50 that are added to that bi-weekly payment once the client exercises that option. Keep in mind, the accelerated bi-weekly option is only available when a brand new mortgage is being advanced. It's not an option that can be implemented after the mortgage is advanced. After the mortgage is advanced, you can only switch your mortgage payment to either a monthly, semi-monthly, or bi-weekly payment, or weekly, even weekly. But there is no accelerated bi-weekly after the mortgage is advanced. So it is something that the client has to initiate right before when the mortgage is being advanced or being taken as a brand new mortgage.
Right.
So with accelerated bi-weekly, you will pay some extra principal as well. With the lump sum, whatever lump sum you pay would go directly on the principal.
Yes.
In terms of the limitations, I know certain banks, like Scotiabank, for example, they're 15% lump sum payment only. What that means is every year you can only pay 15% of the original mortgage amount as a lump sum. So if your mortgage was $1 million, you can only pay $150,000 as your additional mortgage payments, every additional lump sum payment every year. And this is applicable for a calendar year. Some people get confused that it might be from the day or the month from when the mortgage was advanced. So if the mortgage was advanced in June, then it'll be a June to June cycle. That's not the case. It's based on calendar year. So from 1st of January to 31st of December is when this is applicable.
Right.
With BMO, you can put a 20% mortgage lump sum payment annually. So again, if your mortgage was $1 million, you're allowed to pay $200,000 as additional lump sum payments. Another thing I want to clarify is a typical question I get is, hey, do I have to put this $200,000 together? That's not the case. You can pay up to $200,000 in any denomination. So you can pay $1,000, $5,000, $10,000, $20,000, even $500. The minimum lump sum payment you have to make with BMO is $100 or more. So as long as you're paying $100 or more, that would be has to be the minimum payment, and there is no restriction on the number of times you can actually make this lump sum payments during the year, as long as the minimum is $100 and you don't go over your 20% annual threshold.
No, that's great. And you mentioned that is based on the original mortgage amount. So say you're up for renewal, you're halfway through, you had $1 million mortgage, now you're at 500,000. Does that amount, so in our case, 150,000, does that amount still carry through if you're halfway through your mortgage, or does that reset when you come up for renewal?
Yes, that's a great question, Eric. So the beauty of your mortgage coming up for renewal is on the date when your mortgage comes up for maturity or it matures. So let's say your mortgage matured on 1st of March 2023. On 1st of March 2023, your mortgage becomes fully open. So what that means is technically, if you want, you can pay off your entire mortgage without any fee, any penalty, any breaking fee, because the mortgage became fully open. And one of the reasons why, and this goes back to our previous question where we were talking about mortgage renewals, the reason why people are able to shop when the mortgage is up for maturity is because on the date when the mortgage matures, the mortgage becomes fully open, which means they can switch it to any other institution without any fee, any penalty, because the mortgage matured. It became fully open. So going back to your previous your question and my previous answer, when the mortgage becomes fully open, on the day the mortgage matures, it becomes fully open, and you can pay it off in full. You can make more than a 20% lump sum option. So let's say if your mortgage balance on maturity was $1 million, it's normally if your annual lump sum was 20%, you can pay 300,000 lump sum. You can pay 4, 5, 600,000, and there is no restriction, no fee because of the fact that the mortgage was maturing on that particular day and it was fully open.
And that's irrespective of if it was a fixed or a variable. That applies to both.
Yes.
Perfect. So that's really good to know. And now what about, I mean, you mentioned on that day of renewal, it becomes fully open. Is there a timeline that you have to convert to a new mortgage? What does that delay look like?
Well, that typically you'll start working with another institution
right
a couple of months in advance if you were to switch your mortgage. Now, let's say if a client came to me 2 months before the mortgage maturity and say, I'm shopping around, I give them the rate, I say, this is the current offer we have, I can actually lock in that rate or that discount and that offer for that client 2 months, 3 months, 4 months in advance of the mortgage maturing, because we offer a 130-day rate guarantee and an offer guarantee. So whatever, let's say your mortgage is maturing in June this year, we're in February, so we are in that 4-month window where I can actually give you a rate guarantee from now for a mortgage maturing in June, and I can lock in today's promo of the cashback, even though this promo expires on February 17th of this month, and we might come up with another promo after, but I can lock this cashback promo today for you effective until June, because I have that rate guarantee and offer guarantee of 130 days. So when I'm working with a client, let's say if you came to me 2 months before the mortgage maturity, then I would make sure that everything is completed on my side for the mortgage switch effective 2 months from now. And on that maturity date, my bank will send the funds to the client's bank electronically and pay off their mortgage, and automatically the mortgage will be switched over on, let's say, 1st of April, let's say 2 months from now, if let's say that's the date, for that switch to happen smoothly.
So you do have that 1 day to pay that down.
Yeah, you do. In some cases, if I foresee, if a client came to me a little bit late, let's say a few weeks before the maturity, and I didn't have enough time to switch. So what I tell the client is, hey, we don't have enough time to make this go smoothly. However, I would recommend telling your bank to put your mortgage in an open variable mortgage on maturity. So on 1st of April, when that mortgage matures, the bank will put their mortgage into an open mortgage. And what that'll do is it'll give us a few breathing days where it'll allow for that mortgage to remain open. So because we know we are in the process of switching it over, it might go a few days over that maturity date. They will pay a slightly higher interest rate, but it'll allow them to keep the mortgage open without incurring a fee, a penalty, when that mortgage finally switches over. Because if their bank was to lock them in again into a fixed or a variable, then guess what? They're locked in, and then bringing that mortgage over will result in a penalty, which the client doesn't want, and we don't want either. So proactively, we do that to make sure, because a lot of clients are not aware of this. They just think, oh, because they gave us the instructions, everything will go smoothly. That's not the case. So in some cases where I force a delay, if I didn't get the file on time, then I tell the client, hey, just on maturity date, tell your bank to put your mortgage or renew your mortgage into an open variable term that'll allow it to remain open. So we know in the next 3 to 5 days when we switch it over, it comes over without any fee or penalty.
Well, that's a great point, because I assume if clients do nothing and they're presented with these letters, that the bank would roll over the mortgage into a new term. How does that work? If clients do nothing for whatever reason, how does that work? I'm sure you might have seen that in some instances.
So typically, if the clients do nothing, let's say if a client was out of country for whatever reason and they totally forgot that their mortgage was maturing, then depending from bank to bank, some banks will automatically, and even with the notifications, they'll say, if you were to take no action, this is what will happen. Some banks will put you into a 6-month mortgage. It's called a 6-month convertible. So what that does, it's the fixed rate, but at a very high interest rate, because the term is only 6 months. But at the same time, bank realized that you didn't take any action on your mortgage. Could be, again, maybe there was something going on. Again, you could be out of country, or you are probably not getting notifications for whatever reason, or you moved to a new address and you didn't tell the bank that I moved and we didn't have an updated address for you, and your mail is still going to the previous address, which is very common. Then they will only automatically renew you into a 6-month fixed convertible, which will still allow you to make any changes to that mortgage within those 6 months. Some banks will automatically renew you into a 1-year fix. And then so that they don't lock you in for a long period automatically. So depending from bank to bank, it could be a 6-month convertible or a 1-year fix. In both cases, these interest rates are high because the term is so short. But at the same time, they didn't make you commit to a long term or lock you in for a long term where you got stuck with a very high interest rate because of lack of communication from your end.
Right. Well, that's a good piece to know. So, I mean, learning from that is be proactive with that, because you don't want to be stuck with the options of last resort. And to your point, much like I think the cable companies, the Rogers, the Bells, they'll offer fantastic promotions for new clients. Once you're an existing client, that's it. You get fees increasing. So, I mean, the banks play that similar style of role. So know that coming in, and to Kyle's point, know the details. And Kyle said, I mean, 130 days prior to that, you can lock in an offer. So, I mean, that does give a nice window to work on those sort of things. So that's a great piece, Kyle.
Yeah, definitely.
So I am just looking at anything else that we had on our list. I mean, we touched on a lot today. We looked at what your options are at renewal, what you should look for, when you should start the process. We looked at trigger rate and how that applies to variable rate mortgages and what you should consider if you're getting close to that rate. We looked at fixed versus variable. Kyle gave us an update on the current landscape with regards to interest rates, and that's as of February 8th, 2023. So take that into consideration. Things might go up or down, but Kyle has an update on those rates daily, so he can speak to that. And then we also talked about kind of looking at paying down the mortgage, what the options are at conversion, how it becomes an open mortgage, and then what the conversion process looks like for that really conversion from either fixed to variable or to a new term. So a lot that we covered today. Kyle, if there's anything else, so we have both of our emails and cell our office numbers here. So if you do have any follow-up questions, you can also use the comments below, and we'll monitor those. But feel free to send out an email if you wanted to chat. If you're a few months away from a renewal, be a great time to engage either myself or Kyle and look at what those options are. So I'd be more than happy to look at that together. So I'll pause here, and Kyle, if you had any last farewells, I will pass it over to you.
No, I just again wanted to say that we are in very different times. I don't think as Canadians we've ever seen this kind of a rate environment in recent memory. I know not at least in the last 14, 15 years since I've been doing this, where we've mostly seen either consistent rates or we've seen just low rates, and we are not used to seeing this. So I would just tell clients that be proactive and shop around when it comes to your mortgage maturities, or even if you're looking to buy a new property, because banks these days are very, very aggressive because there isn't too much business coming, to be honest. Like there isn't too much real estate activity, and banks are very aggressive. So you can actually get some really good interest rates and offers to go along with that. You just have to shop around, and it's a good time to be. I mean, it's not a good time to be a client from current rate environment perspective, but it's a good time to be a client from rate shopping perspective, because the banks are so aggressive right now in terms of competing for your business, that it puts you in a position of advantage. And especially if you are an A+ client who has great credit history, great income, I'd say the banks are happy to roll the red carpet for you. And I say this not just as someone who works for BMO, but I say, if like yesterday I got a quote from someone saying, "Oh, my broker is offering me this rate," and I couldn't match. I said, "You know what?" I looked at the rate. I said, "That's a great rate. Like, I don't even want to like waste your time or my time. That's a great rate. Just go for it." So at the end of the day, we all want what's best for our clients, unbiased. So I'd say shop around, ask around, and make sure you're getting the best rates possible, because even that 0.10 saved on an interest rate will go a long way in helping you with your mortgage balance, your mortgage principal, and your mortgage monthly payment. So I would say just be proactive and shop around.
Great way to cap off. So thank you for that, Kyle. Thank you for all the insights you shared today. Very much appreciated, and hope all the clients and anybody listening will get a few nuggets of wisdom through this. So as I said, please reach out if you do have any follow-up questions. If you want to look at any other scenarios, or you'd be interested in any other videos about this, let us know, and we'd be happy to do a follow-up part 2. So with that, I will close it off. Say thanks again to Kyle, and thank you for listening.
Thanks, sir. Thanks for having me. Always a pleasure.